Imagine you're sitting at a desk across from someone who sells life insurance. They slide a proposal toward you like it's perfectly normal. And then, with complete confidence, they say something like, "This is a participating whole life policy with paid-up additions, non-direct recognition loans, it passes the 7-pay test, the modal premium is quarterly, we set a target premium, and we added waiver of premium, accelerated benefits, plus a conversion feature through age 70. And then they stop. They look at you. They smile. And they ask, "Any questions?" If you've ever been in that moment, you know the feeling. It's not that you're unwilling to learn. It's that what you're hearing doesn't sound like English. It sounds like a private language. And that language barrier, right there, is one of the most expensive obstacles in personal finance. Because when you don't understand the words, you can't evaluate the deal. You can't spot the risks. You can't tell what's truly being offered versus what's just being implied. So today, we're going to change that. Think of this episode as your decoder ring. Welcome to Wiseside Life and Legacy. I'm your host, Nakel Nakima. And this is episode 2, The Language of Life Insurance. I'm going to walk you through the essential vocabulary that shows up in basically every policy, every illustration, every benefits packet, and every conversation you'll ever have with an agent, an HR department, or a financial advisor about life insurance. By the time we're done, I want you to be able to look at that piece of paper on the table and actually know what it says. Not vaguely. Not, "I think I get it." I mean truly understand it well enough to ask the right questions and make a confident decision. This episode is the companion to episode 1. Episode 1 was the why. Why life insurance exists, who it's for, what promise it's trying to keep. Today is the language. Because every strategy we talk about later uses these words. If you don't own the vocabulary, the rest of the series is harder than it needs to be. Here's the structure, because this is a long solo deep dive and I want you to feel the momentum. We're going in 5 teaching blocks. Block 1 is the Big 5. If you learn nothing else, learn these. Block 2 is the money inside permanent policies. Cash value, loans, dividends, and a couple of terms that people confuse constantly. Block 3 is riders. Those add-on features that can either make a policy dramatically better, or quietly more expensive with little benefit. Block 4 is what I call lifecycle and lapse language. The terms that describe what happens over time, including the protections built into the contract and the ways policies can go wrong. And Block 5 is application. We're going to talk through how these terms show up on a real declarations page so you can read your own policy and understand it. Every term in this episode gets 3 things. 1. A plain language definition. 2. An example so it feels real. And 3. Why it matters, because vocabulary isn't trivia. These words affect real money and real families. Alright. Let's get into Block 1. Block 1, the Big 5. These are the 5 roles and numbers that form the skeleton of a life insurance policy. If a policy were a body, this would be the structure holding everything up. Term number 1, premium. Premium is the amount of money you pay to the insurance company to keep the policy active. Think of it as your required payment for the promise you're buying. It might be monthly, it might be quarterly, it might be once a year. But however the payment schedule works, premium is your side of the contract. Here's an example. Let's say a healthy 35-year-old buys a 20-year term policy for $500,000 of coverage. Her premium might be about $42 per month. As long as she pays that $42 on time for those 20 years, the insurance company is responsible for paying the $500,000 if she dies during that period. Why does premium matter? Because it's not random. It's priced based on your age, your health, your lifestyle, the type of policy, and the amount of coverage. 2 big premium notes to store away. First, term insurance typically has a premium that stays level for a set number of years, like 10, 20, or 30. Second, permanent insurance can have premiums that are either fixed or flexible depending on the product. And one more point that can save you a lot of pain later: the cheapest premium is not automatically the best deal. Sometimes a very low premium, especially on certain universal life designs, can be a warning sign that the policy is underfunded and could be more fragile later. Cheap and good are not the same sentence. Term number 2, death benefit. The death benefit is the amount paid out when the insured person dies. It's the main number, the headline. Sometimes you'll hear face amount or face value. In most everyday conversations, those are just alternate labels for the same death benefit number. Example: a father owns a $1 million policy. He passes away. His beneficiary files a claim. The company pays $1 million, usually income tax-free in the United States, often within a month or two after the paperwork is complete. Why does death benefit matter? Because that is what the entire policy is built to do. Everything else inside a policy is either supporting that number, changing that number, or changing how you pay for that number. And yes, in the US, death benefits are generally paid income tax-free to beneficiaries. That tax advantage is one of the biggest reasons life insurance is a cornerstone tool in financial planning, and later in this series, we're going to talk about how that interacts with retirement planning and estate planning. Term number 3, beneficiary. The beneficiary is who receives the death benefit. Usually you can name primary beneficiaries, the first in line, and contingent beneficiaries, sometimes called secondary beneficiaries, the backup recipients if the primary beneficiary can't receive the money. Example: a wife names her husband as primary beneficiary. She names her 2 adult children as contingent beneficiaries, 50-50. If she dies and her husband is alive, he receives the payout. If they die in the same accident, the money goes to the children. Now here's where the story gets serious, because this is one of the most common and most expensive mistakes people make. Your beneficiary designation usually overrides your will. Let that settle. Because many people assume their will controls everything. It doesn't. Life insurance has its own instruction sheet, and that instruction sheet is the beneficiary form. So if your will says, everything goes to my spouse, but your policy still lists an ex-spouse from 15 years ago, there's a very real chance the ex-spouse gets the money. It happens. Often. And another crucial detail: naming a minor child directly as beneficiary can create problems because insurers generally can't pay a large benefit directly to a minor. That can push the money into court supervision until the child becomes an adult. There are smarter approaches, like trusts or custodial arrangements, and we'll cover that later in the legacy-focused episodes. For now, your takeaway is simple: update beneficiaries after major life events. Marriage, divorce, kids, deaths, changes in relationships. Make it a habit. Term number 4, policy owner. The policy owner is the person or entity that legally controls the contract. The owner can change beneficiaries. The owner can take loans if the policy has cash value. The owner can cancel the contract. The owner makes decisions. And here's the detail that surprises people: the owner is not always the same person as the insured. Example: a wife buys a policy on her husband. She pays the premium. She owns the policy. He's the insured. She also names herself as beneficiary. In that setup, she controlled the policy the entire time. Why does ownership matter? For everyday families, ownership is mostly about control and clarity. For higher net worth families, ownership can also affect estate taxes and planning. That's why you'll sometimes hear about trusts owning policies, especially something called an ILIT, an irrevocable life insurance trust. We will go deep on those later. But right now, store the roles: owner controls. Beneficiary receives. Insured is the life being covered. Which brings us to term number 5, insured. The insured is the person whose life the policy is based on. When the insured dies, that's what triggers a death benefit payout. Example. A company takes out key person insurance on a top executive. The business owns the policy, pays the premium, and is the beneficiary. The executive is the insured. If that executive dies, the business receives the payout to help stabilize operations. Why does insured matter? Because the insured is the person who goes through underwriting. The insured's age, health, and risk profile drive costs. And once a policy is issued, you can't just swap the insured like you're changing a name on a membership card. If you want coverage on someone else, that's a different policy. Let's recap the big five in one clean pass. Premium is what you pay. Death benefit is what gets paid. Beneficiary is who gets paid. Policy owner is who controls the contract. Insured is whose life is covered. That's the skeleton. Now we move to block 2, the money inside. This is where misunderstandings multiply, especially when people compare term insurance to permanent insurance. Some policies build value over time. Some do not. And a lot of arguments online, like heated, endless arguments, are basically people talking past each other because they aren't using the same vocabulary. Term number 6, cash value. Cash value is the accumulation, or savings-like, component inside a permanent life insurance policy. Let me be extremely clear, term insurance does not have cash value. Term is pure protection for a set period of time. Permanent insurance, like whole life or universal life, can build a pool of value inside the policy as you pay premiums. How does it work in simple terms? When you pay premiums into a permanent policy, part of your money pays for the cost of insurance and company expenses, and part of it goes into a value bucket inside the policy. That bucket can grow over time, often tax-deferred. Example. A 35-year-old buys a whole life policy and pays $5,000 per year. After 10 years, they might have, say, $45,000 of cash value. After 30 years, it might be well into 6 figures depending on the policy and performance assumptions. Why does cash value matter? Because it's a real asset with real options. You can potentially borrow against it. Sometimes you can withdraw from it. Some people plan around it for supplemental retirement income. But cash value also comes with trade-offs, internal costs, the way the early years can be inefficient, and the reality that not all permanent policies are designed with the same goals. The main point today is vocabulary. Cash value is the value inside permanent coverage, and it's a big reason permanent insurance costs more than term. Term number 7, surrender value. Surrender value is what you actually receive if you cancel the policy and walk away. And here's the kicker, surrender value and cash value are not always the same. Many policies, particularly in the early years, have surrender charges. That means the policy might show a cash value number, but if you actually cancel, the check you get could be less. Example. A policy statement shows $12,000 of cash value after a few years. But the surrender charge schedule says that in year 3, surrender charges still apply. If the fee is large, the policyholder might only get $7,200 when they surrender. Why does surrender value matter? Because it reveals the truth about short-term decisions. Permanent life insurance is not built for quick, casual exits. If you buy a policy and cancel a couple years later, you can lose a meaningful portion of what you paid. So hold this distinction tightly. Cash value is what the policy says is inside. Surrender value is what you keep if you leave. Term number 8, policy loan. A policy loan is borrowing from the insurance company using your cash value as collateral. This is often marketed as a magical feature. It's powerful, yes, but it's not magic. It's a loan. There's interest. And there are consequences. Example. You have a policy with $80,000 of cash value. Your child is starting college. You request a $50,000 policy loan. The company sends funds, generally without a credit check because your cash value secures the loan. You pay interest on the outstanding balance. Important element: if you die with a loan outstanding, the insurer subtracts the loan balance from the death benefit before paying your beneficiaries. So a $500,000 death benefit with a $100,000 loan could produce a $400,000 payout. Why does this matter? Because poorly managed policy loans can damage or even collapse a policy, especially in flexible premium policies where costs can rise. If the loan and interest grow too large relative to remaining cash value, the policy can lapse. And a lapsed policy with loans can generate a nasty tax surprise. Policy loans can be useful, but they demand maintenance and respect. Term number 9, dividend. In life insurance, dividend usually refers to a payout made to policyholders of participating whole life policies issued by mutual insurance companies. A mutual insurer is owned by its policyholders rather than outside stockholders. When the company performs well, it may distribute some of the surplus back to policyholders as dividends. Example: a policyholder receives a $1,200 dividend. They may have choices: take it in cash, use it to reduce premiums, leave it to accumulate, or use it to buy paid-up additions, which are little chunks of extra permanent insurance that can increase cash value and death benefit. Why does dividend matter? First, dividends are not guaranteed. Ever. Second, despite that, many major mutual carriers have long histories of paying dividends annually for over a century. That track record matters, but it is still not a contractual promise. Third, dividends are often treated for tax purposes like a return of premium up to your basis, meaning they're generally not taxed in the way people assume. The takeaway: dividends can be meaningful, but they're not the same as interest in a bank account and not the same as stock dividends. Term number 10, premium mode. Premium mode is simply how often you pay: yearly, twice a year, quarterly, or monthly. It sounds boring, but it can change the total cost. Many insurers charge a little extra for paying monthly. It's sometimes called a modal factor. Over a year, that convenience cost can add up. Example: the annual premium is $1,200. You might expect $100 a month. But because of monthly mode charges, you might pay $105 or $107 per month instead. Over 12 months, that's meaningfully higher than the annual option. Why does it matter? Because when budgets allow, annual premium mode is often cheaper. Monthly can be necessary, but you should know you're paying for the installment feature. Let's recap Block 2. Cash value, the inside accumulation in permanent insurance. Surrender value, what you actually receive if you cancel. Policy loan, borrowing against your cash value. Dividend, surplus returned on participating policies, not guaranteed. Premium mode, payment frequency, sometimes with extra cost. Now Block 3, riders. Riders are add-ons to the policy, optional features that can change what the policy does. Some are incredibly valuable. Some are fine. Some are expensive for what they provide. Let's go through the 8 most common riders you're likely to encounter. Term number 11, waiver of premium rider. This rider basically says, if you become totally disabled under the policy's definition, the insurance company will waive your premium payments while keeping the policy active. Example: someone has a 30-year term policy. 5 years in, a serious accident leaves them permanently disabled and unable to work. If they have waiver of premium, the policy can remain in force without them having to keep paying premiums. Why does it matter? Because for many working adults, disability is statistically more likely than early death. Waiver of premium is often relatively cheap, and it protects the policy at precisely the time someone might be least able to afford it. Term number 12, accelerated death benefit rider. You might also hear living benefits. Same general idea. This rider lets the insured access part of the death benefit while alive if they are diagnosed with certain qualifying conditions, often terminal illness, chronic illness, or severe critical illnesses. Example: Someone is diagnosed with late-stage cancer and a short life expectancy. With an accelerated benefit rider, they may be able to receive a portion of the death benefit early, money that can be used for treatment, debt payoff, family support, or simply to reduce financial stress during an awful season. The remaining death benefit, if any, goes to beneficiaries at death. Why does it matter? Because it turns life insurance into a tool that can help in life, not only at death. Some carriers include this at no extra cost, others charge. You have to read the policy. Term number 13, Long-Term Care Rider. A long-term care rider allows the death benefit to be used for qualifying long-term care expenses, like nursing homes, assisted living, memory care, or in-home care. Example. A man develops Alzheimer's in his 70s. Care costs can run $80,000 to $120,000 a year in many areas. A long-term care rider may allow access to death benefit dollars to help cover those costs. Why does it matter? Because long-term care is one of the biggest financial risks in retirement. A rider like this can create a hybrid solution. If you never need care, your family still receives a death benefit. If you do need care, you have a funding source. Term number 14, Term Conversion Rider. This is usually found on term policies, often included, and it gives you the right to convert your term coverage to permanent coverage without new medical underwriting. Example. A woman buys term at age 30. At age 40, her health changes and she might not qualify for new coverage at a reasonable cost. But because she has conversion privileges, she can convert some or all of her term policy into permanent insurance without taking another medical exam. Why does it matter? Because conversion can be an escape hatch if your health changes or if your needs change. Here's the warning: conversion rights usually expire at a certain age or after a certain time. If you value this feature, you need to know the deadline. Term number 15, Child Term Rider. A child term rider adds small term coverage on your children as an add-on to your policy, often covering multiple children for one rider cost. Example. A parent adds $10,000 or $25,000 of coverage per child. If something tragic happens, the rider provides immediate cash for funeral expenses and time off work. Why does it matter? Most children don't need life insurance for income replacement, because they don't earn income. But this rider can still provide practical benefits, final expense coverage. Sometimes a path to future insurability for the child, and peace of mind. Term number 16, Return of Premium Rider. This rider, typically on term insurance, promises to refund premiums paid if you outlive the term. Example. Someone buys a 30-year term with return of premium. They pay a higher premium each year. If they survive the full 30 years, the insurer refunds the premiums. Why does it matter? Because it sounds better than it often is. The extra premium you pay for this rider, if invested elsewhere, could potentially grow to more than the refund. Also, the refunded dollars aren't adjusted for inflation. A dollar paid 30 years ago is not the same dollar today. Return of premium is not inherently a trick. It's just frequently an inefficient use of cash for many households. Term number 17, Guaranteed Insurability Rider. This rider gives you the option to buy additional coverage at specified future dates without having to prove insurability again. Example. A 25-year-old buys a policy and adds guaranteed insurability. The rider allows them to add coverage at ages 28, 31, 34, and so on, even if their health gets worse. Why does it matter? Because it's protection against future health changes at a stage of life when your financial responsibilities might grow quickly. Term number 18, Accidental Death Benefit Rider. This rider pays an additional amount if death occurs due to an accident as defined in the policy. Example. A policy might pay $500,000 normally, but with accidental death benefit it might pay an additional $500,000 if death is accidental. Why does it matter? Because it's marketed as double coverage, but accidental death is a smaller slice of mortality risk than most people assume, especially as you age. So the value is often lower than people think. It isn't always bad, but it's not automatically a must-have. Let's recap Block 3 quickly. Waiver of premium keeps the policy alive if disability hits. Accelerated death benefit, access some death benefit while living during certain illnesses. Long-term care rider, use death benefit for care expenses. Conversion, move term to permanent without underwriting. Child term, small coverage on children. Return of premium, refund if you outlive the term, usually at higher cost. Guaranteed insurability, buy more later without medical reapproval. Accidental death, extra payout for accidental death only. Now we move to Block 4, lifecycle and lapse terms. This is where time, deadlines, and small oversights can create big consequences. Some of these terms are consumer protections. Some of them are warning labels. And if you've ever heard someone say, "I had life insurance once, but I guess it ended," this is the block that explains how that happens. Term number 19, free look period. The free look period is the window of time after you receive your policy, often 10 to 30 days depending on your state, when you can cancel and get your premiums back. It's basically a no questions asked return policy. Example. A person receives the policy packet, reads it carefully, and realizes a key feature is not what they believed they purchased. If they cancel during the free look period, the policy is unwound and the premiums are refunded. Why does it matter? Because it's your last clean exit. This is why I always tell people, when a policy arrives, don't just file it. Read it. Compare it to what you were told. If something is off, the free look period is your leverage. Term number 20, grace period. Grace period is the time after a premium due date when the policy stays in force even though payment hasn't been made. Often it's around 30 or 31 days. Example. Someone misses a payment because a bank card changed or a payment draft failed. The policy doesn't disappear immediately. If they pay during the grace period, coverage continues. And if the insured dies during the grace period, the company typically still pays the death benefit, minus the premium that was due. Why does it matter? Because it's a safety net. But it's a short one. Term number 21, lapse. A lapse is when the policy terminates because premiums weren't paid in time, or, with some permanent policies, because cash value was depleted and could no longer support the internal costs. Example. Someone owns a universal life policy and assumes the cash value will carry it. But costs rise, performance is lower than projected, or loans were taken. Eventually the cash value can run down and the policy can collapse. Then it lapses. Why does it matter? Because lapse is the silent killer of life insurance. Policies don't always end with a dramatic phone call. Sometimes they end with a missed notice, a wrong address, a misunderstanding, or a policy that wasn't monitored. And the tragedy is that in many cases, a lapsed policy is a problem discovered too late, when a family expects support and finds out coverage isn't there. Term number 22, reinstatement. Reinstatement is the process of restoring a policy that has lapsed. It's not guaranteed, and it usually has requirements, paying back premiums, sometimes paying interest, and often proving insurability again. Example. Someone discovers their policy lapsed 18 months ago. The insurer may allow reinstatement within a 3 to 5 year window. The policyholder pays what they missed, completes a health questionnaire, maybe does an exam, and if approved the policy resumes. Why does it matter? Because if you discover a lapse, you shouldn't automatically assume you're out of options. Reinstatement might be available, and it can be far better than applying for a brand new policy at an older age or worse health. Term number 23, conversion. We touched conversion in riders, but here we're using conversion as a life cycle event. Conversion is the act of changing a term policy into a permanent policy. Typically using the conversion privilege. Example. Someone has a 20-year term policy that's about to end. They're now older, Premiums for new coverage are high, and health has changed. If conversion is available, they may convert some coverage into permanent insurance and keep it beyond the term. Why does it matter? Because term is designed to expire. Conversion can be the bridge that prevents an expiration from becoming a disaster. Term number 24, replacement. Replacement is when you cancel an existing policy to buy a new one. Replacement can be appropriate sometimes. But it can also be a costly move driven by incentives. Example. Someone has had a whole life policy for 15 years and has built meaningful cash value. A new agent says, "This new policy is better, let's switch." The old policy is surrendered and the new policy starts over, with new fees, a new surrender charge schedule, and new early year inefficiencies. Why does it matter? Because replacement resets the clock. In many cases, the first several years of a cash value policy are the least efficient years. So replacing a mature policy with a brand new one can destroy value. Replacement is regulated for a reason. If someone recommends replacing an in-force policy, that should trigger a second opinion, ideally from someone who isn't paid more if you switch. Let's recap Block 4, Free Look, your refund window after delivery. Grace period, your short buffer after a missed premium. Lapse, termination from non-payment or depleted values. Reinstatement, restoring a lapsed policy under conditions. Conversion, exchanging term for permanent. Replacement, canceling one policy to buy another, which requires extreme caution. Now Block 5, reading your policy. Because here's the payoff moment. Vocabulary is great, but the real win is when you can open your own documents and make sense of them. Most policies have a first page that functions like a snapshot. It's often called the declarations page. If you've never looked at yours, you're not alone. A lot of people buy coverage, store it away, and never read it again. But if you can read that page, you're no longer stuck hoping everything is fine. You can actually verify it. So what does a typical declarations page contain? Usually near the top you'll see a policy number and an issue date. The issue date matters because it anchors timelines, like contestability periods and rider deadlines and other contract mechanics. You'll see the insured listed. That's the covered life. You'll see the policy owner listed. That's the person or entity with control. If those are different, now you know what that means. You'll see the face amount, or death benefit, often in big, obvious numbers. You'll see premium. Often it shows the annual premium and then breaks it into the premium mode you chose, monthly or quarterly and so on. Then beneficiary designations. Typically primary and contingent. Names. Sometimes percentages. Read that section slowly. This is where huge mistakes hide in plain sight. You'll also see riders listed, sometimes with abbreviations. That's where your waiver, conversion, accelerated benefits, child rider, and other add-ons will show up. And if the policy is permanent, you may see references to cash value, surrender value, dividend options, or loan provisions elsewhere in the contract and in your annual statements. Here's what I want you to hear: if you can read that first page and understand what it's saying, you're already ahead of most policyholders. You're no longer the person nodding while someone else explains. You're the person who knows what you own. And that changes everything, because vocabulary gives you leverage. Now, before we wrap, I want to turn this into action. This week's assignment is a simple self-audit. It should take 15 to 20 minutes. Step 1. Find every life insurance policy connected to you. Individual policies. Employer policies, anything you can access. Step 2. For each policy, write down 5 items using today's vocabulary. Number 1, premium, how much and how often. Number 2, death benefit, the face amount. Number 3, beneficiaries, primary and contingent, names and percentages. Number 4, riders, list them. If you see a rider you don't recognize, that's not a reason to panic. It's just a reason to ask a question. Number 5, if it's permanent, current cash value and current surrender value from your latest statement. Step 3, ask yourself 3 questions. Are my beneficiaries current? Not, I think so. Are they actually correct today? Are my riders working for me? For example, if you have term insurance, do you have conversion privileges? If you're depending on the policy through working years, would waiver of premium be important? And finally, is the coverage still aligned with my obligations? The amount that made sense 5 years ago might not match your life today. That's the audit. Simple, but powerful. Now let's close with the one line that captures the reason this episode exists. You can't make informed decisions using words you don't understand. The moment you learn the language is the moment you stop being a target and start being a buyer. Let's do a final lightning recap of the terms we covered. Premium, death benefit, beneficiary, policy owner, insured, cash value, surrender value, policy loan, dividend, premium mode, waiver of premium, accelerated death benefit, long-term care rider, conversion rider, child term rider, return of premium, guaranteed insurability, accidental death benefit, free look period, grace period, lapse, reinstatement, conversion, replacement. That's more than enough to read a policy document with confidence. Next episode, we move from language to math. How much coverage do you actually need? Not a guess. Not a rule of thumb from the internet. We'll walk through multiple calculation methods, including the one many professionals actually use, so you can find your number. Until then, do the self-audit. Pull the policies. Read the declarations page. Write down the 5 items. And if anything doesn't make sense, circle it, because now you know what questions to ask. I'm your host, and this has been Wiseside Life and Legacy. Educate. Empower. Protect your legacy. We'll see you next week.